Welcome to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or buy rating on my 33-question research checklist. Today, we're unlocking a powerful secret in every savvy investor's arsenal, the investment checklist. I'll walk you through my 33-question framework that separates the market's gems from the duds. We'll dive deep into 9 categories, from fundamentals to management quality, valuation, and more. You'll learn how to leverage quality scores and top quartile benchmarks to make data-driven decisions that could supercharge your portfolio. Get ready to elevate your investing game. This is Stock Spotlight, where we turn market noise into crystal clear signals. Let's dive into the heart of my investment strategy, my 33-question investment checklist. This powerful tool serves as an initial quality screener for potential investments. But before we jump in, a quick disclaimer. Cyclical companies tied to commodities may not fit this model perfectly due to artificial inflation or deflation from recent market cycles. Also, banks are excluded from this analysis due to their unique business structure. Picture this checklist as your financial Swiss Army knife. It's designed to dissect potential investments across 9 crucial categories, drawing intelligence from industry-leading sources like Stock Analysis, Guru Focus, Moody's, and Glassdoor. Each question demands a straightforward yes or no, culminating in a quality score that represents the percentage of yes responses. But we don't stop there. I've developed a comprehensive quality scoring system that ranks stocks against my extensive database, also incorporating Schwab's A to F rating on a numerical scale and Guru Focus's aggregated score, which is out of 100. Tested on 191 stocks over the last 2.5 years, the mean quality score is 58%, with a standard deviation of 15%. The top quartile benchmark of receiving a pass rating is 70%. This indicates that about 2/3 of stocks fall between 43% and 73%. Notably, we do see extremes like Delta Airlines at just 21% and Novo Nordisk at an impressive 91%, underscoring the importance of variation within the dataset. Let's peel back the layers of our 9 categories, starting with the bedrock of any solid investment, fundamentals. This section of the checklist explores the relationship between assets and liabilities, the importance of stable gross and operating margins, and what constitutes a competitive net profit and free cash flow margin. First question, are assets greater than liabilities? Usually you want this positive, but note that there are some cases where negative shareholders' equity is actually okay, specifically if a company has so much cash that they're buying back shares that's shareholders' equity. Second question, is the gross margin stable or improving? Now, I look over the last 5 years, but you can always extend the timeline to 10 years. Third question, is the operating margin stable or improving? I like to look over the last 5 years, but you can always extend to 10 years. Fourth question, is the net profit margin competitive? I want a minimum of 10% or at least greater than the industry average. The 10% I got from some research I did online, and the industry averages are as of January 24 from NYU Professor Demordian's database. The fifth question, is the free cash flow strong? I like a minimum 15%, which I got from some research I did. Don't SBC adjust here given the additional effort required for each company, but I do SBC adjust for my portfolio tracking. If you do adjust for stock-based compensation, then 10% might be better as a benchmark. Next, management. The management section has 2 questions that evaluate management effectiveness. One, is shareholder dilution kept in check? I aim for 1% or less over the last 5 years, but this isn't a hard rule when deciding on a new investment. For high growth companies, I might accept slightly higher dilution if it's fueling expansion. My checklist does seek the ideal, but I do want to note that I maintain flexibility in final evaluations to balance both capital preservation with growth potential. Second question is, do employees recommend the company? I specifically look at each company's Glassdoor reviews page and compare their likelihood to recommend rating versus my database. Within my database, the median is 74% with a top quartile benchmark of 81%. I will also glance at a few other metrics on Glassdoor like percentage that have a positive business outlook. Next, industry, where I have 5 questions comparing the company to its peers. The first one, are gross and operating margins above industry averages? It's important that a company has more pricing power and lower costs than its competition, And for this question, I use the latest quarter trailing 12-month data from stockanalysis.com versus the NYU database from January 24. The second question is return on equity competitive. So I use the latest 5 years data from stockanalysis.com, also against the NYU database again. And I give a yes if the company's longer term average is greater than the current industry average. I also do the same thing for return on assets. And here I use Guru Focus instead of the NYU database, and I will give a yes if it's greater than the industry median. The third question, does the company have an economic moat? If a company gets a narrow or wide moat rating from Morningstar, they get a yes here. If they don't have a Morningstar moat rating, then I do the analysis myself. I then have 3 questions that help me assess operational efficiency. The first one is revenue or net income per employee in the top quartile among all stocks in my database. So if trailing 12-month revenue or net income per employee falls within the top quartile for that company's sector, then they get a yes here. For employee data, I do use Stock Analysis Employees page, and I use the latest fiscal year. The second question is return on invested capital, or ROIC, exceeding the cost of capital, or WACC. First is the latest quarter trailing 12-month ROIC, and I want it to be at least larger than the WACC by 2%. And this helps ensure that the company is ultimately creating value on its invested capital. The second ROIC question that I have is the 5-year average ROIC in the top quartile among all stocks in my database. So then here, I just want to see how high those returns are over a longer time period. The top quartile in my database is 24%, with the average closer to 17.5%. I also just pulled this to do a double check in the NYU database, and they have an average ROIC of 14.7%. So I think we're pretty close, but I think I might be just choosing some higher quality companies to do analysis on. And one thing I don't do that's also worth looking at in your checklist potentially is ROIC trend. Ideally, you want this going up. I then have 4 questions that examine both fundamental and technical momentum. I think it's important to have both when evaluating recent stock price performance. The first question that I ask is revenue growing consistently? I want total revenue to have increased year over year for the last 2 years. Then I look at, is operating income growth at least matching revenue growth? Not only do you want revenue growing, but you also want operating income growing as fast, if not faster. I then look and see whether the stock price momentum is positive. I evaluate technical momentum by analyzing the 12-1 month momentum indicator, which measures the stock price performance over the past year, excluding the most recent month. This approach is supported by research as an effective way to gauge momentum. And we check to see if this is positive and above the industry median, which would suggest strong relative performance. I use the data from Guru Focus. The fourth question is, are earning beats and upward revisions frequent? If a company has had 3 out of the last 4 quarters of EPS beats and has more full year up EPS revisions by analysts, then they are showing strong signs of momentum. I use Seeking Alpha for this question. I then go into growth. There are 3 questions that focus on both historical and future growth. So is next fiscal year's revenue growth expected to remain strong? I want next year's forecasted revenue growth to be at least 75% of the last 5 years' average revenue growth. I then look at free cash flow per share and earnings per share to see if both are above the industry median over the last 3 years, and I utilize Guru Focus for that. There are then 2 questions that assess a company's valuation. I do want to note here that there's several more valuation methods, and my portfolio specifically focuses on forward free cash flow yield. And you'll also see in podcast deep dives that I do 4 or 5 different metrics, but the 2 that I will discuss here and that I use for my initial screening valuation are good starting points. Is the EV to EBIT ratio attractive? I want the current multiple to be less than its 10-year median or its industry median. If not, it gets a no. Next, I then ask, is the free cash flow yield competitive? You need to consider whether the growth justifies the valuation. I use enterprise value here, not market cap, and I compare the company's trailing 12-month free cash flow yield to its 10-year median and also the 10-year treasury yield. It gets a yes if it's greater than at least one of those. 2 questions evaluate how the company uses its cash is the next section as part of capital allocation. The first one being, is the dividend payout ratio sustainable? I pulled trailing 12-month data from Stock Analysis, and I want that ratio to be between 0 and 50%. Ideally, you're looking for a company with a high ROIC and a low payout ratio. The question I ask is the total shareholder distribution reasonable compared to free cash flow? I pulled the latest 4-year average and I eventually went to get to 5 years and see if that average is less than 100%. If it is, then it gets a yes. There are then 7 questions that examine the company's financial stability, which form the Solvency and Liquidity section. The first is the debt to equity ratio manageable? I pulled the trailing 12-month data from stock analysis and see if the ratio is less than 150%. After that level, you have to start diving deeper into their capital structure. I then ask, is interest coverage strong? So interest coverage is the ability to pay back debt using current operating profits. 5.0 seems to be the minimum that historical financial professionals such as Benjamin Graham recommended, but I use a 10.0 benchmark to be extra safe. If the company has an interest coverage ratio of at least 10.0 or is at least at industry median, then it does get a yes for this question. I then look at the Altman Z-score and whether that indicates financial health. This score comes from Guru Focus and is adjusted depending on if the company is manufacturing or not. Those that are not manufacturing actually have an Altman Z2 score. For manufacturing companies, I'm looking for a minimum benchmark of 3, while non-manufacturing get 2.60. This comes from research others have done on the Altman Z-score. And I will also give a yes if a company's Altman Z-score is positive and trending up over the last 5 years. I then look at whether the credit rating is solid. Not every company is big enough to get a Moody's credit rating, but for those who do, I want an upper medium grade of A3 or above. Now, if you are okay with a medium grade, you could also screen for Baa3 or above. 3 more questions. Is the cash to debt ratio favorable? I want a 1.0 ratio, which is a nearly net cash position, or at least meeting their industry median. I get this data from Guru Focus. Next, is the current ratio healthy? I have a minimum yes of 1.50, but a company can also meet its industry median as well. I do look for less than 5.0 as current ratios above that come with some red flags and more questions. Our last question is, are accounts receivables well managed? I want days sales outstanding, which is how fast a company collects its receivables, to be trending down over time. For a company to receive a yes on this question, DSO for the latest fiscal year has to be no more than 1% greater than DSO from 4 years ago. And that wraps up today's episode of Stock Spotlight. I hope you found our deep dive into the 33-question investment checklist both insightful and actionable. Remember, this framework is designed to help you separate market gems from duds across 9 categories. By leveraging quality scores and top quartile benchmarks, you're now equipped to make more data-driven investment decisions. If you enjoyed today's episode, please subscribe, leave a rating, or drop a comment. Your feedback helps us grow. For real-time updates and insights, follow me on X at invest091. Join me next on October 3rd when we'll dive into Elf Beauty, ticker symbol ELF. Until then, keep your investment smart.